Salary sacrifice is a term used to describe the practice of an employee directing a portion of their pre-tax income into superannuation, rather than having it paid to them personally. And the benefit of this? Well, it can save you tax. The less tax you pay, the more you have left over to invest. Salary sacrifice is a type of concessional contribution and forms part of your concessional contribution cap limit. In the current 2024-25 financial year, the concessional contributions cap limit is $30,000. Please remember that other contributions such as employer contributions and personal deductible contributions also form part of this cap limit. When wages are salary sacrificed to superannuation, the money gets taxed at the superannuation rate of 15% as opposed to your marginal tax rate. The tax saving you get is the difference between your marginal tax rate, which can be as high as 47% when the Medicare levy is included, and the 15% tax on contributions. To give you an idea of how this may work, let's look at an example. Chris works as an office manager, earning $140,000 per annum. Chris decides to salary sacrifice $1,000 per month or $12,000 per year into her superannuation. This is on top of her 11.5% employer contribution. By doing so, her taxable income is reduced by $12,000, but she incurs an additional 15% contributions tax on the $12,000 contributed to super. Given this, her estimated personal tax payable reduces by $4,190, but tax paid by her superannuation fund increases by $1,800. This gives Chris a net tax saving of $2,390. You receive the tax benefit each pay cycle as the amount of tax your employer pays on your behalf under the PAYG system is reduced. In Chris's case, even though she was salary sacrificing $1,000 a month, her after-tax income would only reduce by an estimated $650 per month thanks to this tax saving. There are many potential benefits of salary sacrifice, including the following. 1. Reduced tax payable. Salary sacrifice reduces your assessable income, which in turn reduces the amount of personal income tax you will pay. 2. Boosted retirement savings. By increasing super contributions, you'll have more money invested within superannuation for your retirement. 3. Tax-efficient savings structure. Superannuation can be a very tax-effective vehicle to save as earnings within your super fund are taxed at a maximum rate of 15%. 4. Forced savings plan. Additional money is allocated to your retirement savings before you get the chance to spend it. This creates a great forced savings plan, and eventually you will adjust your expenditure to account for the reduced income. And 5. Employer incentives. In some instances, your employer may offer incentives to make voluntary contributions to superannuation. You need to check your employment contract to see if any incentives are available to you. But before implementing a salary sacrifice arrangement, it's important to consider the potential risks. Let's go over some of the key risks to consider when salary sacrificing to superannuation. 1. Reduced take-home pay. Reducing your pre-tax income will lower your take-home pay. This means having less money available for living expenses and alternate wealth-building strategies such as paying down debt. 2. Contribution cap limits. You are limited to how much you can salary sacrifice. As discussed, salary sacrifice forms part of your concessional contributions cap limit. If you exceed your cap limit, you may have access to carry forward unused concessional contributions. If not, tax implications will apply. Please note, if you're currently in an untaxed superannuation fund, the standard concessional contributions cap limits may not apply to you, so you need to seek specific advice. 3. Limited access to funds. Superannuation savings are preserved until you meet a condition of release. For most people, this condition is reaching preservation and retiring from the workforce. There are some instances where you may be able to access the benefits earlier, such as release on compassionate grounds, financial hardship, or under the First Home Buyer Super Saver Scheme. 4. Understanding your investment strategy and fee structure. Before putting any additional money into your superannuation, you want to ensure you understand and are comfortable with the investment strategy and the fee structure within your super fund. 5. Division 293 tax. For high income earners, if your combined income and concessional contributions exceed $250,000 in a financial year, you may face an additional 15% tax on some or all of your super contributions, totaling a 30% contributions tax. And 6, legislative changes. Superannuation is subject to potential legislative changes as the government may tweak the rules that apply to superannuation. Implementing a salary sacrifice arrangement is relatively easy. Simply discuss this with your payroll department and they can advise you on the process to get it set up. In the right circumstances, salary sacrifice to superannuation can be a great strategy to implement in order to help boost your retirement savings. It is effectively like getting a tax deduction for investing for yourself. If you think salary sacrifice to superannuation is an appropriate strategy for you, we strongly recommend you speak with your financial advisor. They can help assess the appropriateness for your particular situation. Please note, the information contained in this video is general in nature only and does not take into consideration your objectives, financial situation, or needs. As legislation is constantly changing, the accuracy of this information is only relevant as at the time of recording. Before relying on the information, you should check to see if the content is still relevant.